market's not beating you. You beat yourself. The market didn't blow your account. You blew it. 90% of the time, you knew before you took that last trade that blew your account, you shouldn't have done it. And you shouldn't be doing it. But you didn't stop. Because you're caught up in that gambler's loop. You're numb to it. Oh, well, if I blow it, I'll just reset it. And then I'll feel fresh with a brand new start. But it doesn't feel that way, does it? Because now you're scared. The next trade you take on your new one, I don't want to have a losing trade because that means it's going to freak me out. I'm going to jinx it. And then I'm going to go right back in the same thing. But you lie to yourself in that last trade before your account gets blown. If I blow it, I'll just reset it and I'll be fine. But you're not fine. You're building thicker and thicker scar tissue. And it's hard to trade in that. And if you're trying to be an online personification of a successful trader, but you're not proving that because you keep having to reset your accounts, that is even worse of scar tissue. So it's unfortunate because I teach these things and I prove it, and my students that do well and listen to it, they stand out. But I do have students that can trade, but they don't know how to wrestle themselves. They haven't done the documentation stage of their own development. In the beginning, they didn't do the things I'm teaching in this mentorship 2024. They have not spent any time doing that. So that's why they have hit and miss results. That's why they can make money. They can get a payout or two and then blow it. And they go into a tailspin for months. And then they might make a little bit of money again down the road, but then they blow it again. What's broken? Them. They are the underlying issue. You are always going to be the underlying issue. It's not the method. It's not the market doing it to you. It's you. So with that foundation, I want you to think about how 99% of retail traders have no concern for trying to make themselves prepared for the ebb and flow of profitability, losing in the beginning. They just want it to be a lottery win, and it's off to the races for the rest of their life. They just keep making more money. The way the market capitalizes on that weak mindset is because they're ill-equipped. The first thing that the market does every single day is it hides the narrative. What is a narrative? What the market's actually going to do for the day that makes the daily candle. That's the real candlestick range theory. Not that bullshit you see fucking panded around on Twitter right now. Nonsense. The narrative on how that daily range is going to form. It starts with, are we going to have an up close or a down close on the day? You're not trying to predict the closing price. You're just looking at the monthly, the weekly, and the daily to determine what is the probabilities for the market to go lower and close lower or go higher and close higher. What would be things that would help with that? Well, if the monthly and weekly chart are reaching for an old high and they're in close proximity to it relative to that time frame, it still might be hundreds or 1,000 handles away still. But you can see clearly that it's drawing to that higher time frame area of either inefficiency or an old high or an old low, something to that effect. And then in the daily chart, you start seeing each individual daily candlestick still moving in that direction, even though they may have one or two days that are opposing that. If we're bullish, you might see one or two down days in the week. But majority of the days of the week, majority of each individual daily candle is usually an up day. That means it's confirming that it's gravitating towards that weekly or monthly draw. And by hiding the narrative, I mean that they're going to cause some kind of initial excitement. That's the Judas swing in the morning. Okay, and what they'll do is they'll use the 8:30 news time, even if there is no economic calendar release. 8:30 still creating some kind of a Judas swing. Now think about that. We would expect, the news is going to push the market around. That's what they'll say. The news pushes price up and down. No, it doesn't. The buyers and the sellers at the time of the news, when nobody can even get trades in, but yet it's buying and selling pressure. You see how fast this shit falls apart? But because they say it to you so many times, and it's in every book, and everybody just regurgitates it and says the same thing over and over again. Hitler proved it. You tell a lie big enough and loud enough and long enough, eventually everybody will believe it. But when I'm standing here telling you, this is what it really is doing. And then what I'm telling you it's going to do, it does it. And not that I'm trying to prove that you need to be right or that I'm trying to prove that I'm right. I'm just saying the logic is right. That's the point here. Okay. So it cuts through all the bullshit that retail stuff leans on and has a religion around. No matter what school of thought you have, the market, okay, if we can personify the market like some people like to believe it is, it's the buying and selling pressure. Okay. Okay. Well, how is it that the market collectively decides that it's going to run against the traders that use harmonic patterns that day? And maybe not Wyckoff traders. Or the supply and demand guys that have been using the demand zones, if that's what they're going to use to get into their trades. Why is it that they get targeted that day and not the Elliott wave traders? Because they're never all in agreement. And when you take a step back and you think about all this stuff like that, it's like there must be something else going on. Because is it like, okay, this week we're going to let Elliott wave traders do well because you got to keep the book sales and course sales and the mentors that teach that bullshit. We got to keep them making money. And then we had to let Dow theory and Gann and Hurst cycles do well in the coming weeks too. And then we got to come back to point and figure because there's a lot of old heads still trading with that colors. So how can you kill them all and not have to do very much and make it simple? Run old highs, trade to inefficiencies. It's simple. You kill everybody. The algorithm doesn't need to know Wyckoff theory. The algorithm doesn't need to know what harmonic patterns are in play right now, what Gartley patterns there, what bat patterns there. I know all about all that shit, the butterflies, all that stuff, okay? The only butterflies I see in trading is my students when they're doing it right. They get butterflies, okay? There's no fucking butterflies in patterns in the charts. That's nonsense. It's garbage, okay? It, again, is another religion. It's a fairy tale. The truth is the market only goes up to tap into pending buy-side liquidity. Or it goes up to rebalance and or redeliver to an inefficiency. That's all it goes up for. That's the only reasons why it goes up. The market goes down to trade into sell-side liquidity, the low and low or relative equal lows, because there's pending orders down there. Or it goes down to a inefficiency. That means like a fair value gap below market price to reprice to or rebalance that inefficiency. That's the only reason why the markets go down. I'm telling you to just go into the market with that mindset and forget everything else. And suddenly the charts will start talking to you. It'll be clear what it's doing, where it's reaching for, where it's not going to go. Then when you understand the elements of time that I'm teaching you, you can time when it does these things. Wyckoff doesn't ever teach time. Elliott Wave does not teach the times I'm teaching these macros. It's not there, folks. Supply and demand, never mentioned it. Larry Williams never mentioned macro times. And he was my first mentor. Buy everything he has in writing. Buy every single one of them, okay? And I promise you, you'll never see that stuff there. He wasn't the inspiration for the macros. That's not where that came from. That's not where that came from. What's another one? George Angel. No mention of a macro. His spyglass, his LSS system for day trading the S&P makes no mention of it. Zero. Nope. So if we understand that the market makers they are the handlers, the owners of the algorithm, the price engine. The engine itself that delivers price, and I'll explain a little bit more detail what that means by a price engine and how it delivers price. You're gonna learn a lot today, okay? But the algorithm is owned and handled by the market maker. It's not a single person. It's an entity. And you're not going to meet them. I'm not going to be able to point to this is where they live, this is where they're at, but it's an entity. Okay? It's a collection of people that they run it, like a casino. Okay, so we as speculators, as traders, we go in and we buy and we sell at the price that is offered and controlled by said algorithm. That algorithm has a predetermined script. This is how high it's going to go for the day, and this is how low it's going to go for the day. And I've proved this in Forex, and I've proved it now in futures. You don't need to trade short the high of the day. You don't need to go long the low of the day. But you need to have an understanding of how and where those levels might form. And you only need to know one of those parameters in the beginning. So that means if you're bullish, what level do you need to worry about most? Not that worrying is a good word to use here, but what you should be consumed with in terms of pursuing the deeper understanding of what price is going to do. If you're bullish, if you think that monthly chart and that weekly chart is going to keep going up, and your daily chart just had a down close candle yesterday and hasn't changed anything structurally to indicate that it's going to keep going lower, it just went down into a discount array, into a daily fair value gap, into a daily order block that's bullish, then it's reasonable to anticipate the very next day what? The market's going to open, trade down initially. That's a Judas swing. And in that drop, I'm going to be buying that. If I miss it, if I miss the actual entry because I get to my charts late, something keeps me from seeing it at the chart, I'm talking to somebody, I just don't see it because I'm human. I miss it. I'm on the phone. Anything. I could be at the bathroom. There's a number of things that's going to prevent you being in every instance of a trade where you can expect it forming. Because I've had a lot of those instances as a younger man, that's why I work so hard at creating new buying and selling opportunities to get into a trade that's already underway. So that's why I got 81 ways to do it. So if you're bullish, you're expecting that initial manipulation. So you're only focusing on worrying about where the low is going to form. If you're bullish, you're only worried about how the daily low might form and where it might form at. You're not trying to predict the closing price because chances are your closing price might be lower than it actually is, and it could just keep going higher and higher and higher. So you go into an understanding of the daily candlestick forming by understanding what the monthly and the weekly and the daily charts are indicating. If you had a down close day yesterday, chances are, if everything's still bullish, you're probably going to have an up close day today. That means at 9:30, using the NQ, ES, and Dow futures as a medium to talk about this, at 9:30, what I'd like to see in that situation is an initial small little rally higher to get people in buying long. And then they drop it down into a discount. Some overnight low, relative equal lows, some overnight sell side liquidity pool, or maybe a fair value gap that's formed between, 2 o'clock in the morning to 9:30. And if it also overlaps with a new day opening gap, new week opening gap, or a first presented fair value gap from the previous day, chances are that's going to be the low of the day. But the key is if I'm bullish, I want to see two things happen. I want to see a small little minor rally first that trips in buy-side breakout artists. They're buying on a stop. And then they're going to look for the most recent swing low. That's where their stop loss is. Well, that's where it's going to do Judas to and through. So it's going to jump a little bit, look like it's going to go higher. The public will chase that, even if they don't have an order that's going to buy at a breakout on a 1 or 5 minute chart. And then it drops. And it stops them out, and it stops out anyone overnight that may have a long position on. That's the perfect scenario for a Judas swing on a classic buy day. Is that complicated? If you're brand new, this is the first time you're listening to me, it probably does sound complicated. But if you've been with me for a little while, that's an easy recipe. It's easy. If you don't have a confluence of those factors coming together, or at least 3 things are telling you something there, not just a PD array, there has to be something else there. Time, You're inside that opening range between 9:30 and 10 o'clock. You're seeing buy side trip initially, and then they get rigged across the close by the drop down, which makes the low of the day. That trades into an overnight, which means London session, 2 o'clock in the morning to 9:30 opening bell. Some low there. It doesn't have to go to the lowest low of London either. So at 9:30's opening price, you'll see a little fluctuation above it that takes buy side, and then you'll see this little tail that's dropping down. When you're zoomed in on these 1 minute charts, like you see every live streamer has their charts zoomed in real close, they're never seeing it form because they're too close to the trees to see the forest. So that's why you have to have one time frame that's zoomed out a little bit, like a 15-minute time frame. It gives you a perspective that you wouldn't otherwise have because you're zoomed in on these 1 minute charts. And every individual 1 minute candle, or less if you're looking at 15-second charts, you're lost. You have no idea what's coming on and then what's going on. But you focus on one side of the range. If you're bullish, you're looking for the low of the day to form. If you're bearish, you're looking for the high of the day to form. You are not trying to be perfect in timing. You can anticipate it forming in that first hour of trading. So from 9:30 to 10 o'clock, your high or low will form. Majority of the time, you'll see that form in the first 30 minutes. Sometimes in the first few minutes. But the high or low of the day for equities, or indices rather, is going to form in that first 60 minutes of trading. So 9:30 to 10:30, which is not any coincidence as to why I'm teaching my son to focus on his trading being done by 11 o'clock, because he's going to graduate to holding on to a trade past that point based on what he's done in the morning. And he'll trade the whole daily range. While everybody else out here nickel and diming it, scalping it here and scalping it there, he'll do that in the beginning of the day, maybe even pre-session once he gets good. And then he'll nail down the low of the day when he's bullish, and he'll hold based on time. That means he's going to stay on the trade until 10 minutes to 3 Eastern time, minimum, because that's the macro beginning of that last final hour. And then he'll babysit the position after that and trail his stop loss and protect whatever range open profit he has. And that's how you trade the daily range. That's power 3.